Hello, this is Professor Dean Mead, and this is the first lecture in Advanced Topics in Governmental Accounting, the subject of which is Accounting and Financial Reporting for Post-Employment Benefits. The purpose of this lecture is to educate you in what GASB's pension standards, which governments are in the process of implementing right now, and its newly issued OPEB standards, which came out just last June, what they require state and local governments to do, how they're different from the old standards, what they will result in terms of information that's being provided in audited annual financial reports, and also to understand as we're going along why GASB made the changes that it did. We'll begin just by making sure everyone's on the same page in terms of the basic terminology that is used related to pensions and to OPEB. Excuse me, look at the basic manner in which the pension or OPEB liability is measured, and then talk about the specific requirements in GASB standards for measuring the long-term obligation related to pensions and OPEB, measuring annual cost, reporting those in the financial statements, and disclosing information about them and other important information about pensions and OPEB in the notes to the financial statements, and the presentation of important contextual information, historical information about pensions and OPEB in required supplementary information. So let's begin with making sure we're all familiar with the lingo. When we're talking about post-employment benefits, we mean first and foremost pensions, and we also mean other post-employment benefits, or OPEB, which is predominantly retiree health insurance and other forms of health care for people after they are no longer working for the government. They're referred to as a whole as post-employment because some people may be eligible to receive them when they're not technically considered to be retired from their personal perspective. They are retired from that government, but they may be working for another business or another government while they're collecting benefits from the employer who gave them the retiree health and benefits. For instance, somebody may have worked the 25 required years, but they started when they were 25, so now they're only 50. They're not retiring, but they've decided to leave the employment of the government because they've worked the full number of years you have to work in order to get your full pension, and so they're leaving the government, perhaps already eligible to receive that pension, and they're going to go work somewhere else where they may in fact earn additional post-employment benefits. In addition to retiree health insurance, OPEB also includes any other kind of post-employment benefit that is provided separately from a pension plan. And the most common form of these that I'm aware is the provision of life insurance. There are two basic types of pension plan and OPEB plan. One is the defined benefit plan, which involves an employee earning a specific amount of benefit in the future, and therefore the government and the employee need to make sufficient contributions between now and retirement to ensure that there's enough money in the plan to make those payments. So the amount of the benefit is defined, it's guaranteed, as opposed to defined contribution plans where the terms of the plan specify how much is going to be contributed to each individual employee's account, sort of like a 401k or a 403b, but how much the employee gets upon retirement in terms of actual benefit payments depends upon how much is contributed and how well the investments in that fund perform. There is no guaranteed benefit to the employee. It depends entirely on how well the investments perform in the plan. Most of the big deal in terms of accounting and financial reporting has to do with the defined benefit plan because in order to report a liability related to that obligation, the government needs to go through a process of having an actuary conduct a valuation on which they will base the measurement of the liability and the annual pension cost. When it comes to a defined contribution plan, the only liability a government would have to the employee is for contributions to the plan that it hasn't made yet. But because the employee is not guaranteed a particular benefit in the future, the government has no other liability to them. Their only requirement is to make the contribution to the 401k or 403b or some other type of plan, and then the government's responsibility ends at that point. So what we're going to talk about mostly, or really almost entirely in this lecture, are defined benefit plan requirements. The defined contribution plan requirements for accounting and reporting are very simple. They're going to report an expense or expenditure for the amount that they're required to contribute, and that's pretty much the end of it. There are some note disclosures, but they're really more descriptive in nature than anything else, and they're not very extensive, certainly nothing compared to what is required in the notes to the financial statements for a defined benefit pension or OPEB plan. It's also important to understand, that this other way of looking at plans in which there are three different kinds, and it affects what requirements, what accounting standards a government has to apply. And a government's pension or OPEB plan is going to fit one of these three categories, starting with single employer plans, which means that there's just one government, one employer involved in the plan. All the members of the plan are employees and retirees of that one government. And then the other two are multiple employer plans, where there's more than one government involved. And they do that for economies of scale and to get better or greater investment earning power by combining all of their contributions together and investing them as one. They're going to get much better returns than they would if each of those governments in the plan invested themselves, even if they had the capacity to do so. And it certainly reduces cost because there's only one overhead for the whole plan. And each government isn't incurring investment expenses. They're being incurred once for the plan as a whole. So one of those multiple employer plan types is called an agent multiple employer plan, in which the accounts of each government are kept separate from the other governments. So the contributions of the employees and the employers related to a particular government are, kept separately, in terms of tracking how much is there and available to pay benefits, and the benefits for those members, the employees and retirees of that government, are made only from the account of that government. The assets are all combined for investment purposes, but they keep track of how much belongs to each member government, each participating government. On the other hand, with a cost-sharing employer plan, they combine the assets not just for investment purposes, but the benefits are paid out of that common pool of assets to all of the members of all of the participating governments. So they are sharing, in fact, in the cost of providing those benefits. Typically, you will see in the accounting standards, there are certain things that governments in single and agent multiple employer plans are required to do that a cost-sharing plan is not. The difference used to be quite extraordinary under the old pension and OPEB standards. Cost-sharing plans really didn't provide very much information at all, and the board's rationale under those prior standards was that the information wasn't available for each individual government because the actuarial valuation was done for the cost-sharing plan as a whole, and so a user of the information could look to the plan's financial statements. If there were no financial statements of the plan, then the cost-sharing employer would have to provide more information on their own. But if they did issue that separately issued financial report for the plan itself, then that's where some of the basic information could be found. But there was no requirement to present information individually by each multiple employer plan participating government. That will change very significantly. So the difference between what a single or agent employer presents and what a cost-sharing employer presents is greatly diminished. It's also important to understand how GASB views the substance of a pension or OPEB transaction between an employer government and an employee, because it is the basis for the approach that the board takes to accounting and financial reporting for post-employment benefits in a manner that is different from what is required for the private sector. The, the GASB doesn't look at this transaction as being a discrete transaction that takes place each year. It looks at the transaction as one that covers the full time of service of the employee. So if an employee is working for a government, that it's a transaction that essentially proceeds over the full 20 years rather than being 20 individual transactions in each year. This is relevant because the board feels that there are certain aspects of the pension liability that can be recognized as pension cost over multiple years rather than the full change in the pension liability from year to year, or OPEB liability being recognized each year, the entire change in pension expense or OPEB expense right away. Any employee has essentially two forms of compensation. They have current compensation in the form of salaries and fringe benefits. And then they have deferred compensation, which is the post-employment benefits. And the fact that they don't receive that deferred compensation until sometime in the future when they leave the employment of the government doesn't make that compensation any less related to the period in which it's earned. And that means that if a government incurs a new liability for more benefits, more post-employment benefits in a given year, the cost of that should be recognized in this year, with certain exceptions based upon the board's view that that this transaction is one that lasts over the entire career of the employee. So let's talk quickly about the basic approach to measuring the liability, which hasn't changed under the new standards. The way that an actuarial valuation is done hasn't changed. It's just that certain of the assumptions and methods that are used in the valuation have changed, and the idea behind which is to make the resulting measurement more comparable across governments and more consistent over time. So, at the risk of insulting actuaries everywhere, I'm just going to boil the process of conducting an actuarial valuation and the measurement of the long-term obligation for pensions and OPEB down to 3 steps. The first is to project future cash outflows for benefits after the employee has left the government and is eligible to start receiving benefits. You take those future cash flows and discount them to their present value, their actuarial present value, and then you take that actuarial present value as of today and you allocate it, a part of it to past periods of service and a part of it to future periods of service. And let me show you, graphically what we're talking about here. So if you're looking at any given employee, there are 4 key time junctures that are involved in the valuation of the liability related to the benefits for this employee. The first is how old they were when they were hired. The second is how old they are now. So that helps you to determine how long they've worked. They've worked for 15 years so far. What their age will be, what they assume the age will be at their retirement based upon historical experience with the actual members of the plan. And that will tell you then how many more years that person's going to work, another 22 years. So combined, the expectation is that this employee is going to work for 37 years and accrue pension and OPEB benefits over that time. So that altogether, that 37 years is considered their service period. And then the last date that's important is when they're expected to die, which is based upon mortality tables that are relevant to the particular population that is covered by the plan, so as close as possible to the actual members of the plan and their experienced mortality. In this case, the assumption is that the employee will live till 80, and therefore, will be receiving benefits over an 18-year period between 62 when they are eligible to receive the benefits and 80 when they die and they are no longer receiving the benefits. So the projection of benefits is done based upon the terms that are specified in the pension or OPEB plan. Typically with a pension, you're talking about some formula that involves the number of years they've worked, a percentage that you multiply it by, and then some measure of their earnings. It used to be the case that that would almost always be whatever they earned in the last year. That has changed a lot over time in order to reduce the cost of pension benefits. So for instance, a government might require that the salary that the pension payments are based on is, the average of the final 3 years, or the average of the three highest paid years, or highest paid consecutive years. Um, they may also have some requirements that say that whatever that average is, it can't be greater than a certain percentage above what the first year is. And the reason they do that is to prevent what is called pension spiking, in which in the last year or two of employment, an employee who is eligible for overtime, and that overtime is pensionable, meaning it's counted in the pension calculation. They might work 80 hours a week, that which would include 40 hours at time and a half, overtime, and that really boosts their final year compensation, and therefore really pumps up the amount of pension benefit they get. So in order to stop that practice, many governments have moved to some form of averaging that makes it much more difficult to do a pension spike and artificially inflate the amount of money they're getting, or that they're going to get. One of the other things they're going to take into account here is whether there are provisions for cost of living adjustments over the life of the plan. There might be a provision for 1 or 2% per year, or and those are written into the plan. Those are referred to as automatic COLAs, cost of living adjustments. There may also be, rather than written into the terms of the plan, a practice of a government every 2 or 3 years reviewing what has happened to inflation and providing an ad hoc cost of living adjustment, or COLA. It used to be that those were never included into projections, but GASB Statement 68 requires, that's the pension statements, requires that that a government now include any ad hoc cost of living adjustments if they happen with a regularity that makes them effectively automatic. So they aren't written into the terms of the plan, but they happen so frequently, or or there's an expectation that they're going to happen on a routine basis, and therefore they've effectively become automatic. And so now they should be included in the projection of benefits. And they're also going to make assumptions about inflation and other factors that are relevant to calculating how much is going to be paid in benefits and for how long. So that's going to involve, some idea of what their salary is now, an assumption about what is going to happen to their salaries, how fast they're going to grow between now and the assumed retirement age. And so you see in this example, they think over that 22-year period, the salary will rise from $4,500 to $1,500, $15,000, sorry. And then they're going to project the benefits based on all those things that we just talked about over the full period during which the person is going to be receiving benefits between retirement and mortality. Those projected benefits then are discounted back to their actuarial present value as of today. And that amount is then split between past years, meaning years of service in which the employee has already earned pension and OPEB benefits, and a portion of it is going to be allocated to future periods of service. And this is where the actuarial cost method comes into effect. And as we will discuss more later, it used to be the case that governments had a choice among 6 different types and the new standards essentially have removed all of that choice in order to make the resulting numbers more comparable across governments. This was an area that was heavily criticized as a source of making the numbers that governments were reporting not comparable to one another. The amount that is allocated to past periods of service, that's in gray there, is the basis for the total pension liability as of this date. What used to be reported as the actuarial accrued liability and what will be reported under the new statements as the total pension liability is the portion of that present value of the projected benefits that is allocated to past periods of service. So that's essentially the rudimentary approach to and my very simplistic description of that approach to measuring the long-term liability under the old standards and under the new standards. So let's take a look now at what is required under the new standards for pensions and OPEB. These are actually this is the body of the new standards. 67 applies to reporting by pension plans. 68 and 73 apply to reporting by employer governments for their pensions. 71 addresses an issue in Statement 68. It's very narrowly focused. Statements 74 and 75 are on OPEB. 74 for OPEB plan reporting and 75 for reporting by employers for their OPEB. And then Statement 78 addresses a relatively narrow issue that came up regarding Statement 68. There actually is an exposure draft out right now that will address several other relatively minor issues in 78 that have come up during the period of implementation. But our focus is going to be mostly on Statements 68 and 75 and technically Statement 73 as well. And I'll explain why I'm talking about 68 and 73 for pensions, two statements, and only one statement, 75, for OPEB. And I'm actually going to explain that on this slide. The requirements for reporting defined benefit pension plans and OPEB will differ based upon whether they are being administered through a trust that meets all three of the following criteria: that contributions from the employer and from non-employer entities, so someone other than the government who might be responsible for making contributions, other than the employer or the employee, those contributions are irrevocable. They can never be taken back. Once they're in the plan, and they're dedicated to providing pensions, and they are legally protected from creditors. Statement 68 for pensions only applies to pensions provided through a trust that meets these criteria. The board wasn't ready at that time to deal with plans that were not, but it should be noted that relatively few pension plans, are administered through trusts that don't meet these criteria. It's Statement 63 that addressed it, and it came out at the same time as Statement 75 for OPEB. And so Statement 75 for OPEB addresses both OPEB provided through trusts that meet these criteria and OPEB that is not. And that's actually a big deal, because whereas virtually all pensions are provided through trusts that meet these criteria, hardly any OPEB at all is administered through these kinds of trusts. Hardly any of it's administered through a trust at all, let alone one that can meet these criteria. And that's in part because very few governments actually have set any money aside to pay their OPEB liability when it comes due. They are dealing with it almost entirely on a pay-as-you-go cash basis, whereas even a poorly funded pension plan has lots and lots of money in it because governments are making contributions in advance to those plans. So the standards, when you take them in their entirety, address both governments that with benefits that are in trusts like this and those that are not. And I will point out where that makes a very significant difference. I've alluded to this second bullet here, that it implies not just to employer governments, but also deals with situations in which another government or another entity may be responsible for some or all of those pension benefits. For instance, there may be a state or a county government. Let's take a county government that might have some responsibility for the pensions of teachers in the school districts within that county. Uh, so the standards identify how the employer of those teachers, the school district, should take into account the amount that is being contributed by the other entity. And if that other entity is a government, explains how that other entity ought to be reporting its obligation as well. The upshot of it, and I will say more about this later, is that a government employer, there might be a total liability of say $100 million, but the county government is responsible for half, and so the county government will report $50 million of the net pension liability, and the employer will report the other 50 million. So whoever is really responsible for those benefits should be the entity that is reporting them. There are essentially two kinds of liabilities that a government may have related to defined benefit pensions and OPEB. One is a liability to the plan in the form of contributions payable. So let's say it was supposed to make a contribution on the last day of the month and it didn't. So now it has an account payable, a contribution payable to the plan. But mostly what we're talking about liabilities related to defined benefit pensions and OPEB, we're talking about the liability to the employer, to the employee, that really big number that governments face, and that when you were doing the readings from the Pew Center last week, that's the number they were talking about. They were using the old pension standards numbers, so they were talking about the UAAL, or unfunded actuarial liability. Under the new standards, that will be referred to as the net pension liability, or net OPEB liability, which is the total liability minus the value of the assets in the plan's fiduciary net position. And here is where, well, let me put this off for a second. Sorry. Let me say that if a government is a single or an agent employer, then it's going to represent the entire net pension liability or net OPEB liability as a liability in its financial statements. If a government's in a cost-sharing plan, then each participating government in the cost-sharing plan is going to recognize a share of the collective net pension liability or net OPEB liability for the plan as a whole. And I will talk a little bit more later about how they determine what their proportionate share is. But they still, just like the single and agent employers, are going to have to report their liability for pensions and OPEB in their financial statements. The fact that they're in a cost-sharing plan no longer gives them an out from doing what everybody else has to do. And then the other thing I was about to say, and I was kind of getting ahead of myself, is that if a government is providing pensions or OPEB through a trust, then conceivably it has some assets in that plan, and therefore it would subtract them from the total liability, and it will report the net liability, the difference between them, on the face of its financial statements. But if a government is not providing pension or OPEB through a trust that meets all three of those criteria, then there is no accumulated assets in a plan. There's no fiduciary net position in a trust that can be counted against the total liability, and therefore, instead of reporting the net liability in their financial statements, those governments are going to recognize the total pension liability or total OPEB liability in their financial statements. The measurement of the net pension liability or net OPEB liability that's going to be reported in the financial statements, is technically as of the employer's year end. However, the date upon which the measurement takes place can be as early as the end of the prior fiscal year. And that means both the total liability is measured as of that date, and the value of the assets in the plan are measured as of that date. That measurement is based upon an actuarial valuation that goes through those three steps that I described earlier. If that is not as of the same date as of the measurement date, then it may be as of a date no more than 30 months and a day prior to the fiscal year end. So essentially another 18 months, a year and a half prior to the measurement date. Actuarial evaluations are required to be performed at least every 2 years, with an encouragement that they be done more frequently. And for large plans, for many plans, they're done every single year and not every other year. Um, Now, this may sound like those numbers are, kind of old, but that's actually a shorter period than used to be allowed under the old standards. And the new standards require that if significant things have taken place since the actuarial valuation that are likely to affect the measurement of the liability, then the government will need to do some updating or roll forward procedures in order to take those into account. They may be so significant, in fact, that they have to do an entirely new valuation, but not necessarily. In most cases, they may just need to do some things to take into account, for instance, that a new labor contract was signed in the period between the actuarial valuation and the measurement date. So they may just be able to make some adjustments to the valuation rather than doing an entirely new actuarial valuation. So the measurement of the liability should be based upon much fresher and much more up-to-date information than under the old standards. So I'll just take one of these examples, the June 30th fiscal year end. Um, so the first year for a June 30th fiscal year end that they would implement Statement 68 would be June 30th, 2015. The measurement date could be as early as June 30th, 2014, and the actuarial evaluation date could be as early as December 31st, 2012. But again, if anything that would significantly affect the measurement happens between 12/31/2012 and 6/30/2014, they will need to apply procedures in order to take that into account when they're measuring as of June 30th, 2014. The methods and assumptions that are used in doing the projections, in discounting, in allocating allocating the actuarial present value to past and future periods, all should conform to actuarial standards of practice that are issued by the Actuarial Standards Board, unless the standards specifically say otherwise. Um, that means there are far fewer alternatives than there used to be in the prior standards, which should result in more comparability in the measurements. Um, but I should note that in terms of whatever assumptions and methods go into determining how much a government should contribute to its pension plan, its funding policy, that's completely outside of accounting and financial reporting. And so nothing that has been done in the new standards for accounting purposes, is expected to be applied for a government's approach to funding or determining what its funding policy is for pensions and OPEB.